maybe I'll just spend a little bit of time on it, on modern portfolio.
Yeah.
And I missed, I think I missed a little piece.
Yeah, you didn't finish.
Yeah. Oh, I didn't finish
I
it?
don't think so.
Okay. Thanks for doing that. I guess I ran out of time on the last lecture, which was the modern portfolio theory. And again, the micro exams, and I'll go do a little review session, will be, I'll ask you like the level of the stock market and where oil prices, gold prices, where 10-year Treasury yields are, and the dollar to the pound, dollar to the euro. I'll ask you some questions on supply-demand analysis for those asset classes. I'll have a little technical chart. You will show me support and resistance and trend and those things. Derivatives, I'll give you I'll ask you, prices are forecast to rise, what would be the index, ETF, and the stock trades, just like you would from the memos. If the prices were forecast to go down, what would be that set? I want you to memorize that. And then I'll talk to you about, ask you questions on the product innovation and engineering piece, the modern portfolio theory, yield dynamics, and then some valuation equations, and that's what we're going to do today. Okay, and those will be basically the micro quiz. Okay, and then I'll give I would probably bring maybe 4 blue books. You know what blue books are? Blue books. Bring 4 of those, and then blue books.
Yeah.
Do they still sell them?
Yeah.
Okay. Yeah, bring 4 of those for the 2 days for the micro quizzes, and then you'll write in them. Okay. And then I'll give you the questions beforehand, and then what I'll do is for the exam, hand me all the blue books, and I'll give the blue books back out to make sure that nobody pre-wrote in the exams in the blue books. No incentive to cheat. And then what you'll do is you'll work on the blue books. I'll collect them, I'll hand them back out, or I'll just collect them for the first set of questions, and then you'll work on them, and then give me the second set. And then I'll give them back to you, you'll put them in your deliverable, and you'll hand me the deliverable on Thursday. Not next Thursday, but the following Thursday. Okay? Clear? Okay, and then you'll have a cover page, which will be the university, the class, the term. You'll see deliverable 1 to me, from you, and a date. Then you'll have the memo or the memos stapled together. Then you'll have the take-home exam, the homework, with a cover page stapled together, typed out questions, handwritten answers. Then you'll have the pre-test, and then if you want to submit to me the resume, you'll submit to me your resume, and then you'll use one of those black clips, and clip it all together, and then give it to me. Okay? And then I'll check the package for completeness and order, make sure it's in that order, because I go through a lot of them. And then I'll review the in-class quiz responses, and then I'll give you back the exams. If you've missed some stuff, you'll go back and correct it, and then give it back to me. And then everybody should be, everybody should get A's, right? You have plenty of time to put it together. You had a month or a little bit more to get it done. And we reviewed it a lot. Next week we'll work on some of the problems from the homework and the exams. Again, to double check your answers and to fill in any questions that you may have missed. And we'll just wrap it up and we'll be done with the first third of the course. Okay? Any questions? Yes, sir. Ma'am.
For the homework, is it okay to handwrite the questions too?
If you want to, you can. I was just saying if you wanted to type them out, that might be a little quicker, but if you want to handwrite them, that's cool too. A lot of them are pretty short. Okay. Any other questions? I just had complaints from students that it was a lot of handwriting and they didn't like it. Okay. Any other questions? Okay, let's get into the modern portfolio theory. Okay. And maybe you can give me a guide on where I left off on that, because I want to wrap that up in a 2 the whole session to do the other lectures too, because I don't want to spend too much time and get behind and not have to finish that.
You got the margin basket, is that?
The market basket,
Yeah.
so I basically drew out the capital allocation line. We have the efficient frontier umbrella. We have the risk-free rate at the origin. We have 100% stock portfolio. Expected return on the portfolio, some deviation. Portfolio, you may want to go back and look at the your standard deviation calculation. Stocks. Expected return on stocks. You did 100% bond portfolio. You can reduce. Take on more risk, you get a higher rate of return, you reduce the amount of bonds in your portfolio, and you invest in more stocks. You reallocate the portfolio. If you don't want to take on as much risk and you're willing to take a little return, then you can sell off your stock and buy your bonds. The point in which the efficient frontier is tangent to the capital allocation line is what is called the market basket. This is the point in which you maximize the risk-adjusted rates of return. So the goal is to maximize this. This is called the risk-adjusted rate of return. You'll also see later that they'll subtract out the risk-free rate, that's called the Sharpe ratio. But usually risk-free rates are relatively constant, so I get rid of that and just use that calculation, which is the inverse of the coefficient of variation. So that's this point right here. And then what you have to understand too is that investors in the marketplace would love to be up there, right? Low risk, high return. But there's nothing in the market that's available that gives you high return and low risk. There's no such thing. So unfortunately, these risk-averse investors have to lower their utilities because there's nothing out there. So the point at which the utility curve, the investor utility curve, is tangent to the capital allocation line and the efficient frontier is the market basket. And an example of the market basket between a two-asset portfolio, stocks and bonds, historically, that was really all that was available to invest in. The allocation within the portfolio or the market itself, the total value of the bonds, the total value of the stocks, added together and then divided back to get the percentages. Proportion of the portfolio was 70% bonds and 30% stock. So this is the traditional portfolio allocation to replicate the market. And this was probably in the 20s and 30s, and 40s and 50s, and even up until the 70s, 60s. This was the allocation for institutional investors, which are also risk-averse investors. And institutional investors and risk-averse investors are the bulk of the investors in the marketplace. They're willing to take on risk, but they want to be compensated for it through rates of return. You can also jump off the capital allocation, or the efficient frontier, onto the capital allocation line and move up the capital allocation line through the use of leverage. So in a stock portfolio, you would take on margin. You would borrow from the broker-dealer as a loan, so you don't have to put up as much equity. And if the stock prices go up, your rates of return are exponential. through the use of leverage. So your return on equity, or ROE, is exponential. But if you're wrong, and stock prices actually go down and you use leverage, it's a two-edged sword. Your losses will grow exponentially. You could go bankrupt or wipe out your portfolio in the process. You can also jump off the efficient frontier through the use or the process of lending, or shorting the stock, or buying the puts, or writing the calls. So you can jump off the efficient frontier onto the capital allocation line, and which banks do, they do lending, and they do collateralized lending. So mortgages collateralized by the loans, personal and business loans collateralized by compensating balances or underlying credit of the business or the individual. So you'll move down capital allocation line through the use of lending, reducing the risk significantly, but also reducing the expected rate of return through lending. And again, this one's going to be high risk and high return. Now, the important thing to understand, and you already understand, that if you add assets to your portfolio that have low, no, and negative correlation with each other, that you're going to reduce the unsystematic risk or business-specific risk in the portfolio, so that the only thing that's left is the systematic risk. So in the modern portfolio theory context, or MPT, you add assets to the portfolio, you add assets to the stock bond portfolio, whose returns have low, no, and negative correlation with stocks and bonds. So you're looking to add assets whose returns have low, no, or negative correlations in the returns. So what kind of assets, classes, assets actually do that? Cash value, life insurance, sponsored by mutual insurance companies, New York Life, Northwestern, Guardian, Ohio, private equity, real estate, and private equity, alternative, renewable energy. This is a new asset class that's been introduced. These are called alts, or alternatives. And their rates of return have low, no, or negative correlation with stocks and bonds. So what happens if you add these assets to your portfolio, what actually happens is it bows out the efficient frontier. It bows out this efficient frontier along the capital allocation line. So yes, you're going to get a reduction in the return, but what really happens is you get a significant reduction in the portfolio standard deviation. And institutional investors and risk-averse investors want 8% to 10% annualized rates of return. That's their target return. That's their expected return. So basically, the expected return is fixed. And why would they want the 8 to 10% rate of return? Well, based on the rule of 72, your money doubles in less than 10 years if you can get an 8 to 10%. And that's what they want. That's what everybody wants. Yes.
But for as far as the negative correlation rate, you don't want it to be too negative, right?
No, just enough.
Yeah.
Just enough. Yeah. You don't want complete offset.
Yeah.
Okay. That's correct. Okay. So you're locking in the return. You've already got the target rate of return on the total portfolio. So really the goal is to add those assets whose returns have low, no, or negative correlation and bows out the efficient frontier. and reduces the portfolio standard deviation significantly. So what you end up doing in the process is maximizing the risk-adjusted rate of return and actually increasing it. So the investors love it. Okay? And then the bulk of the capital comes, if you can manage the portfolio, you get assets under management, you get commissions, you get fees, you're extremely profitable if you can continue to do this. And really create what is called alpha in your portfolio strategy. Okay? What else? In the portfolio theory. I think that might be, oh, the last is the target allocations. Okay? These were historical target allocations, but now with the introduction of these alternative assets, from my calculation and from some of the research that I've seen, I've come up with the target allocation based on, supported by research. Okay? So the target allocation for institutional investors and risk-averse investors for the next 30 years is going to be 40% bonds. This is your target for your model portfolio, or your target allocation in a mixed asset portfolio. So 40% bonds, 30% stock, 10% cash value life insurance, Ibbotson and Associates, Ibbotson and Associates basically did these portfolio analytics and came up with the 10% allocation to cash value life insurance. And it's also been institutionally externally validated because most financial institutions, particularly banks, take out life insurance on their senior executives and plow money into the life insurance policies and build cash value in it. And that cash value built in these policies are considered tier 1 liquid capital by the regulators for the bank. So this is the most highly liquid component of their liquidity stack within their balance sheet. And so highly liquid, and it's been institutionalized, and it's been validated, not only from the research, but also in application. Also, private equity real estate. Ibbotson and Associates also did the research in the 80s, did the portfolio analytics, covariances, correlations, all that stuff, and also came up with a 10% allocation to private equity real estate. This is direct investment in real estate, not in REITs or securities or publicly traded bonds. These are direct real estate assets. And again, validated through the research, and under the ERISA laws of the 1970s, Congress validated private equity real estate that basically stated in the legislation that all public pension plans should have private equity real estate in their portfolios. Okay, so again, total validation. The last one is alternative energy. Deutsche Bank, REEF, R-E-E-F, did the portfolio analytics 10 years ago and came up with a 10% allocation to alternative renewable energy assets, such as wind, geothermal, biogas, community choice aggregation utilities, because those assets are long life, just like real estate, and the returns have low, no, or negative correlation with stocks and bonds. These are the alternatives. This has already been established. That product's been around for 167 years. Private equity real estate became institutionalized in the 80s. And then alternative renewable energy, particularly on the private equity side, is less than 10 years old. So this is where the, probably where the product innovation and the capitalization will occur. There'll be more and more investment in these types of assets going forward. Any questions on that? No? Okay. I don't think the book did a very good job of really laying this out. But anybody want to take a picture of that before I get rid of it? Yes? No? Get it while you can. The hot cakes are hot. So now let's talk about yield curves and yield curve dynamics. Why is it important to watch the yield curve, monitor the yield curve, listen to what Janet and company say about inflation and interest rates and interest rate policy? Do we care? Do we care about interest rate policy? Yeah, because all stocks, all bonds, all real estate, all commodities are priced off of the yield curve and are determined by interest rate movements. And the Federal Reserve manipulates short-term interest rates through open market operations through the New York Fed to basically drive bond prices up and down, interest rates up and down, to either cool the economy or stimulate the economy. And the Federal Reserve has basically stated on record a month ago in Jackson Hole that basically the Fed has been the perpetrator of recessions pre-depression and post-World War II. The number one perpetrator of causing recessions was the Federal Reserve. The Federal Reserve was responsible for creating asset price bubbles and has been responsible for creating recessions. Almost every single one post-World War II. So do we care about monetary policy? Yeah. Do we care what the Fed's talking about? Yeah, we do. Do we care about the yield curve and interest rate movements? Yes, we do. Okay. So all debt and equity securities are priced off of the yield curve. The yield curve in most cases is upward sloping, which is called a normal curve. So it's upward sloping. You're going to have interest rates associated with the maturity of the Treasury securities. So you have interest rates on the y-axis, and you have a maturity on the x-axis. And this is also yield to maturity. So you're going to have different interest rates by different maturity. You're going to have bonds that are 1 year and more in maturity. That's called the capital markets. And securities with maturities less than 1 year are called money market. So you can buy 3-month, 6-month, 9-month, 1-year Treasury notes. What's interesting is actually this curve. Interest rates are almost at zero. And what's really interesting is that if you go to Japan, or you go to Germany, interest rates, nominal interest rates, are negative. 3, 5, 7, 10, 20, and 30-year bonds. Their interest rates are negative all the way through to the 10-year. Historically, it's never happened ever, okay, ever in history. That central banks basically initiated quantitative easing, printed massive amounts of money to basically buy bonds and drive the bond prices up so high that they drive interest rates negative. Never happened in history. It actually could risk destroying capitalism in the process because these policies have no theoretical basis. Totally uncharted territory. We'll talk about negative interest rates later. but just to give you the, context in which we live in today. So the yield curve, you got interest rates, given maturities for Treasury securities, U.S. Treasury securities, and these interest rates are considered the risk-free rate. Because the government cannot default on these bonds because they own the printing press. So there will always be money there to pay the coupon interest and the principal when it comes due at the end of the maturity for these bonds.
What's on the left axis?
This is on the y-axis, this is the interest rate or the yield to maturity on the bonds for the given maturity. So interest rate is yield to maturity by maturity, okay? And the curve is upward sloping. Has an upward slope, upward sloping, which is called normal. It's the normal curve. Currently, the yield curve is very steep and upward sloping right now. So it's normal. When determining nominal interest rates for these securities, you use what is called the Fisher equation, based off of Irving Fisher's work. And you need to memorize this. I'll ask you what the equation is. I'll ask you what capital asset pricing model, WACC, and other things are. You need to burn them in your brain. And basically, the equation states that nominal interest rates are equal to the real rate plus inflation expectations. And over the last, since basically the early 1980s, because 10-year Treasury yields were at 16% in early 80s, and now they're at less than 2, so that's 18 to 2%. That's a pretty big drop over a 30-year period. Interest rates in general have been falling over the decades due to lower real rates and lower inflation expectations. But currently, in the short term, real rates are relatively stable, so they're relatively a constant. So really, the movement in interest rates are driven mainly by inflation expectations. Not inflation, but inflation expectations. Okay, that's the terminology. And you'll hear it in the literature. So inflation expectations. Therefore, most investors, yes sir?
I was just wondering how you find the real rate.
The real rate? Well, what you can do is you can take I, nominal interest rate, minus the inflation expectations will give you the real rate.
Oh,
So you just redo the equation. Okay? And actually, real rates right now are negative. Okay? Real rates are negative. Because interest rates are so low right now, and inflation is relatively high, that actually real rates of return are negative. Okay? And you usually see negative real rates in recessions. Okay? When we're not in a recession.
But I guess I'm wondering what actually is the real rate then?
It's basically the base rate. Because interest rates, remember, your rate of return on the nominal interest rates is going to be the real rate if your inflation expectations are equal to 0.
Okay.
So basically, after you take out the inflation premium, right, you get the real rate.
Okay, perfect.
Okay?
Thank you.
And I'll go through that a little bit too when we talk about shapes of the yield curve. Okay, so I'll reinforce that again. So it's really important that you understand this, okay? Because if the Federal Reserve or the market thinks that the economy is overheating, and that's going to drive inflation in the future, expectations will go up, and interest rates will go up. If people think that the economy is cooling and slowing and decelerating and going to go into a recession, they will form lower inflation expectations, and that'll drive interest rates down. So they're positively related to each other. So if inflation expectations go up, interest rates go up. If inflation expectations go down, interest rates go down. And that's really important to understand, because if you're looking at the coupon that's being paid on a bond, just a simple bond model using the perpetuity approach, if interest rates go up, the value of the bonds go down. If interest rates go down, the value of the bonds go up. coupon interest is fixed. So really, movements in bond prices are driven directly by movements in interest rates. And interest rates are determined not only by the market, but by the Federal Reserve. Okay? So your bond portfolio is directly related to monetary policy. That's why they watch the Fed so much, because they're trying to forecast where interest rates are gonna go, and if they're gonna go up, bond prices are gonna go down, and I'm gonna lose. And if interest rates stay low or go down, bond values are gonna go up, and I'm gonna win. And if I think that interest rates are going up and bond prices are going down, I'm selling my bonds. Or I'm writing forwards or futures or buying puts or writing calls, on the ETFs or the corporate bonds, or on the writing forwards or futures on the indexes. Okay. So I can hedge it off. Maybe I don't want to sell the bond portfolio, I can use the derivatives. But if I think they're going up and I don't want to use derivatives, I sell the bonds. Okay. So the key is to understand the movements in interest rates and the effect on bond prices. Okay. And they also do affect stock prices too. So the yield curve is also segmented. And actually this Fisher equation, this is called the expectations hypothesis. It's called the expectations hypothesis. That's the first of the yield curve theories. Okay. And the yield curve, also called the term structure of interest rates, it's also called the term structure. So you may hear the terminology interchanged. We have the interest rates are rising on the short end of the term structure. Interest rates are rising on the short end of the curve. It's also called the curve, or the yield curve. So the curve is segmented by short-term interest rates, medium-term interest rates, and long-term interest rates. Corporations and investors borrow and buy bonds either on the short end, the medium term, or for the long term. Okay, so the market is segmented. That's the second theory, is the segmentation hypothesis. And then the last one is also related to the segmentation hypothesis, which is called the preferred habitat. Because investors in bonds will buy bonds, institutional investors, pension funds will buy long-term bonds because they want to match the liabilities with the assets. Because when the pensioners come due, pensioners start to retire in their defined benefit programs, the actuarials have to project out when these people are going to start retiring so that they can match the maturity of the bonds to the liabilities of the pensioners. So that when they start taking their pension draws, these bonds are coming due and our assets are paying the principal and the interest to pay off the pensioners. So the goal is to match the maturities of your assets and liabilities. That's the goal in corporate finance. So you always want to match the maturity or the duration of your assets, life, economic life, with the liabilities, the maturity. And you want to do that for short term, medium term, and long term for each of those. So basically your balance sheet is segmented by maturity and economic life of the assets and the liabilities. You don't want to have asset liability mismatch because you can run into really big problems. You're using short-term. You don't want to be using short-term liabilities to finance long-term assets. If interest rates go up significantly more and then the return that you're getting on your long-term assets, you're gonna have basically negative arbitrage. And you could become insolvent. So you wanna constantly try to match. So the markets are really set up, these bond markets are set up and segmented by short-term, medium-term, long-term. And investors and borrowers segment across the curve by maturity. The Federal Reserve does not manage long-term interest rates in those cases. They manage short-term interest rates. And then stimulate and cool the economy by buying and selling bonds on the short end of the term structure to drive bond prices up and down and interest rates up and down to cool or stimulate the economy. So you can see the Fed and other central banks and maybe the market will start to sell off bonds along the curve. This will shift the yield curve up. Well, as we know, if interest rates go up, bond prices and stock prices and probably real estate prices will go down. So you can see an upward shift in the curve. You can also see, over time, will be a buy-up of bonds along the curve. And that will drive up bond prices and drive down interest rates and drive up, will drive down interest rates by purchasing the bonds, drive down interest rates and drive up bond prices in the process. So the curves can actually shift down too. So this would be accommodative, this would be restrictive monetary policy. Curves can also, what you'll see is as the stock market starts to bubble up and the real estate prices start to become inflated, the economy is starting to overheat, you're at full employment, wages and wage inflation is starting to take hold, costs of labor are starting to go up, input costs are starting to go up, the Fed will move in and start selling bonds and start driving up interest rates. So what you'll start to see is a flattening in the curve. And this is what would be called a flat curve. And in that case, in a normal curve, inflation expectations are positive. In a flat curve, inflation expectations are zero. So in a flat curve, the nominal interest rates are the real rate. In a flat yield curve, the nominal interest rates are the real rate. Okay? But usually, go ahead.
Is the curve usually pretty still or is it active?
I'm going to show you.
Okay.
Okay. I'm going to do a demonstration once I get done with this. I'm going to load up the computer and I'm going to show you the dynamic yield curve.
Okay.
And I'll walk you through and you'll really see the dynamics associated with it. So, as I told you before, Janet Yellen admitted in Jackson Hole that the Federal Reserve has been the perpetrator of recessions, almost every single recession post-World War II. They overbuy the bonds, drive interest rates too low and create asset price bubbles. Once the asset price bubbles get too high and the economy overheats and starts to create inflation, they start to sell off the bonds, drive bond prices down and interest rates up to cool down the economy. And what they usually do is they oversell. They make a policy mistake. And what they do is they oversell the bonds and they cause the yield curve to invert. Or what is called an inverted yield curve. And when you see the yield curve invert, get ready. Because the stock market will peak in 12 months and it will be in a recession within 24. It's a #1 predictor of recessions. When you start reading about interest rates and monetary policy, they all talk about where are we, what's the curve doing, and does it look like the curve is inverted, or flattening first and then inverting. When's it going to invert? So I would pull up your computers and go to type in dynamic yield curve. dynamic yield curve. And what you're gonna see, click on the dynamic yield curve, stockcharts.com. Does everybody have the page up? Everybody got the page? Yep, okay. Click on that big green button that says see the yield curve. You're gonna get this chart right here. And what we basically have is we have the yield curve here on the left side, and we have the S&P 500 stock market index, which is a leading indicator to the to business cycles. Okay. So you have the peak in the stock market, 98, 99, 2000. You have basically the recession of 2001, 2, and 3. You have the recovery in 2004, stock market and real estate bubble in 2006 and 7. Then you have the financial crisis in 2008, 9. And then you have the recovery period that we're currently in right now. And please note that you can see that the stock market basically bottomed relatively at the exact same support in the prior two recessions. And that the stock market also peaked at the resistance line in the prior two peaks in the prior two business cycles. Okay? So now what you do is you are going to click on animate right there. And what it's going to do is it is going to show you in real time monetary policy over time and its impact on the stock market. So as you can see right here, as we start to approach the peak in the stock market, the yield curve is very flat. And watch it, as we start to get to the peak, it's going to invert. So it's getting ready, all of a sudden, boom, it inverted. And then we go into our recession. Then the Federal Reserve starts to freak out because the stock market is careening, people are getting laid off, production's dropping, the stock prices are crashing. So they basically start to buy bonds on the short end of the curve, creating an extremely steep yield curve, reducing borrowing costs, increasing consumption and investment. And they basically set the bottom right there. And you can see it's upward sloping and it's extremely steep. Then as the economy starts to recover, stock prices lead in every single situation because they're a leading indicator. And as the stock market starts to recover and the economy starts to recover, the Fed starts to sell off bonds. Sell off the bonds, driving down bond prices and driving up the interest rates. So watch as the curve starts to flatten as we get towards the peak. Interest rates are rising, they're trying to cool the economy. Flattens, I think I might have seen it already invert. It's going to invert any second. It inverted, there you go. And if you look at the time period when it inverted, it was basically 12 months prior to the peak in the stock market. That inverts, and it's really inverted right now. Trying to cool the economy and trying to mitigate asset price bubbles that are formulating in the stock market. Then all of a sudden, they prick the bubble, and you have other structural problems associated with the economy, speculation in housing, corruption, mortgage security corruption, and the Federal Reserve steps in because they've never seen anything like this before. And they drive interest rates to basically zero. And they were tempted to go negative, and they'll probably go negative this next time around. They drove short-term interest rates to zero. And then they said that's not enough. We're still under producing jobs and under production. So what we're going to do is we are going to go further out on the curve, start buying longer dated bonds, and start flattening the yield curve on the long end to drive down costs for borrowing costs for corporations to buy plant and equipment in longer dated assets. And just look at zero, and then the curve just keeps being pushed further and further down. And now with negative interest rates in other parts of the world, people are flooding into the United States to buy our bonds because we're providing positive returns on the bonds while everybody else has negative interest rates. So that's pushing down the curve even more, holding down interest rates longer, creating way over acceleration and causing as you can see, the breakout to the upside on the stock market occurred in 2013, and we've basically been in an upward pattern because interest rates are extremely low by historical standards, and it's just fueling the stock market and a real estate market bubble. So the question becomes, when is the Fed going to raise interest rate and prick the bubble? I don't know, I'll leave that up to you to figure out. So that's the dynamic yield curve right there. And it's, how much time do I have? I want to make sure that I stay on track.
40 minutes.
Okay, I'm doing good. Okay, any questions on the relevance of the yield curve and the dynamics of the yield curve? We're going to be invested in bonds and stocks and real estate. We're going to work for a company with a 401k that's probably going to be invested in equities and mutual funds. Going to go work for a company that may be publicly traded. You may be given stock grants and stock options. So you really need to understand the importance of the yield curve and its dynamics, not only to forecast the recession, but also to understand the impact on your wealth and your retirement savings.
So you're saying when interest rates start to rise, about like 12 to 24?
When the curve inverts,
Well,
okay, when the curve inverts,
yeah.
usually the stock market will peak within 12 months and will be in a recession in 24. Okay, that's kind of the rule of thumb. And actually my students and I analyzed this dynamic yield curve over and over and over again. And one of my students noticed, he said, look, I noticed that the curve inverts 12 months before the stock market peaks. And we're in a recession within 24. I said, that's brilliant. And we went back in time and looked at if it was persistent. It's pretty persistent. But you know, everybody who's watching the market totally understands this. That's why they're really focused on what Janet is saying. And the 10-year Treasury yield last week, and as of today, is up 25 basis points. Okay, it's up a quarter of a point already. The Fed didn't raise interest rates yesterday or 2 days ago at their September meeting. They may do it in December, but the yield curve has already shifted up, and 10-year Treasury yields are already up a quarter of a percent. Okay.
So if all these analysts understand that.
All the analysts, all the traders, all the CFOs, all the CEOs, anybody who's anybody knows this stuff. The economists know this stuff.
So then why did no one see the recession of 2008 coming on if everyone knows that?
The 2008 recession was pretty obvious to pick. What we didn't understand is in 2008 and 9 that basically Wall Street and commercial banks were totally intertwined on a global basis. They had all basically manufactured derivative contracts that they were trading amongst each other, and they had over-levered their balance sheet. At least like Citigroup had basically $36 of debt per dollar of equity. And in one case it was 60. And the average is like 8 to 10. So they were like double, triple. The whole system was totally over-leveraged. Okay? Nobody talked about it, nobody was saying anything about it, and it really didn't come true until Lehman Brothers collapsed. When Lehman Brothers collapsed, people who had counterparty contracts with them or had accounts with them or had loans with them, when Lehman went down, it took down the whole system.
So
And Paulson knew what was going on, but he worked at Goldman Sachs. He was an ex-Goldman guy. So he didn't care, he wanted Lehman out. And he took down Lehman, he took down the system.
So the debt just didn't disappear, so where is it now?
The Federal Reserve has printed $5 trillion, and they took a lot of that crap that was sitting on the bank's balance sheet, and they put it on the Fed's balance sheet. So they took basically
That's what
private junk and put it on the public balance sheet.
So that's what the
Because junk.
bailout was.
Yeah, and then the Federal The Treasury basically also issued about $5 trillion in bonds. So the Fed printed $5 trillion, the Treasury issued $5 trillion. So we basically levered up, the public balance sheet, levered up the Fed's balance sheet, basically put $10 trillion on the public balance sheet to bail out the banks. Okay. That's the trick. Okay. And when we watch the Inside Job movie, all that stuff will play out. They'll go over it, they'll show all the perpetrators and the corruption and the lack of regulation that went on, and that both parties were basically going to the trough and they took the system down. And people walked away with billions, trillions, and hundreds of millions of dollars in the process, and no criminal charges whatsoever. Okay, so let's go into the valuation component, because this is really important to understand, because the yield curve, all debt and equity securities in real estate are priced off of the yield curve. So let's go through the valuation models. Okay, so these are going to be in the intrinsic. How much time do I have?
35.
Okay. Can you give me like 30, 20, 10, 5, give me the countdown so I can make sure I get this stuff done. Okay, so when valuing companies, valuing stocks, valuing bonds, valuing real estate, basically the valuation models are all the same. Okay? So these valuation models that we're going to learn, that we're learning in the class, are basically standard valuation models that are best practices by all investment companies, banks, venture capitalists, bond investors, stock investors, real estate investors. We all basically use the same methodologies, and they're all related to each other too. So once you learn them, you got a real solid foundation in valuation techniques. Okay. So the first one is going to be perpetuity. And the perpetuity model basically states that the cash flows, and it doesn't matter what cash flow you're looking at, you could be looking at free cash flow, which is measured by earnings before interest, taxes, which you'll learn in your book and your accounting, the EBIT, which is called free cash flow, that you would use to value firms. So you could use EBIT or EBIT per share. You also probably want to add back depreciation and amortization, because again, that's just an accounting shield to reduce your taxable income. Could also be the coupon interest payment from bonds. Could be the earnings per share stock. Could be the earnings at the enterprise level. Could be the dividends paid to the shareholders. Dividends. The numerator could be a lot of different things, depending on what you're trying to value. And then it's divided by some expected return, also called the discount rate. Expected return, discount rate, also called the opportunity cost of capital. So you'll hear interchangeable terminologies. But again, the equation is basically the same. And the equation's pretty simple. It basically says that the cash flow divided by the cash flow, which is constant, it's going to pay a constant amount each year forever. Okay? You're going to have a constant stream of cash flows that will be paid at a constant rate into infinity, forever. You're going to divide the cash flow by the expected return, or the discount rate, or the cost of capital, whatever it is, and that's going to give you the value of the asset. So it's an income-producing asset. And it could also be net operating income from the real estate. So that's the basic valuation model.
You put an I up there, but I thought I was for interest rate.
This discount rate,
Yeah.
okay, is going to be let's say it's a return on equity. I'm expecting a certain return on the equity. Well, the equity equation is called the capital asset pricing model. In this CAPM, capital asset pricing model, again, you want to memorize that. The capital asset pricing model equation is basically the risk-free rate plus the beta times the return on the market minus the risk-free rate. Risk-free rate. Risk-free rate. So if the risk-free rate goes up, the interest rate goes up, or the expected return goes up, and the value goes down. The risk-free rate goes down, the expected return goes down, and the value goes up. That's why the yield curve is so important to understanding the valuation process, because it is the base rate in all discount rate determination, or expected return determination, or cost of capital determination. It's in every equation to determine the discount rate. So it's in there, okay? And then the return on the market, let's say we're valuing a stock, the return on the market in most cases is the S&P 500, is the benchmark return on the stock market. And the S&P 500's return has averaged 8 to 10% per year for the last 20, 25 years. This is basically 8 to 10%. And the beta basically states that the return on our stock is either going to be higher than the return on the market, or is going to be lower than the return on the market. Or the rate of return on our stock is going to be exactly the same as the return on the market. Those are the different scenarios. And in most cases, for startup companies and smaller companies that are more sensitive to movements in the overall stock market, their beta could be 2 times the market, or as high as 5 times the market, depending on the type of firm and industry, and amount of leverage that they deploy in the company. If the rate of return on the stock moves exactly with the market, then the beta is 1. If the rate of return on the stock is less than the market, then the beta is probably less than 1, probably no less than 0.4 in most cases. These are real estate investment trusts. And there's no such thing as a 0 beta, and there's no such thing as a negative beta. No such thing. Because these companies are traded on the exchange, and when the exchange prices go down, all prices go down in most cases. So there's a lot of market risk. So this is basically a measure of systematic risk, market risk. Okay? So if the risk-free rate goes up, then the expected return goes up and the value of the stock goes down. If the beta goes up, the expected return goes up and the stock price goes down. If the return on the market goes up, the expected return goes up and the stock goes down. If the risk-free rate goes down, the expected return goes down and the stock goes up. If the beta goes down, the expected return goes down, the value goes up. If the return on the market goes down, the expected return goes down and the value goes up. So you have to play with the equation and understand those effects and those impacts. Okay? And that's why I started with the yield curve, because the yield curve is the risk-free rate, which is the base rate in all return, expectations, and cost of capital calculations. Okay? And it's not mentioned really well in the book. Okay? So that's the perpetuity model. Now the next model, how am I doing on time? What is it?
25.
Okay, thank you. The next is Gordon growth. Okay, Gordon growth model. And the Gordon growth model is just a modification of the perpetuity model. It assumes that the cash flows are not constant over time. They actually grow at a constant rate over time. So you have to add in, if this is a constant over time, you take out the constant growth rate in the cash flows over time into infinity, and you subtract the two. Okay? So if this equation goes down because of interest rates or increases in growth rate expectations, then the values are going to go up. If growth rates go down, interest rates go up, it's going to cause the valuation to go down. So just by playing with the variables in the model, you can forecast where stock prices are going to go. This model is used for stocks and bonds, and this one's used for only stocks. Okay? Because bonds, coupons, do not grow. And the principal that you get at the end of the maturity in the bond do not grow either. Okay? And that's why bonds are extremely sensitive to movements in inflation expectations and interest rates, because the numerators are fixed. The only thing that moves is the denominator. And actually, the longer the bond, the more compounding periods there are. So movements, slight movements in interest rates for long-dated bonds magnify the movements in the prices. Longer maturity bonds are more sensitive, price sensitive, more elastic to movements in interest rates. And since stocks are considered long-term assets, they also are highly sensitive to movements in interest rates. But you have an offsetting growth component in the numerator that could offset the increase in interest rates. Maybe interest rates move up, but the growth rate expectations of the cash flow could go up even further, which means that values will continue to go up even in a rising interest rate environment, because earnings are growing at a faster rate than the increase in the interest rates, okay, or the cost of capital or expected returns. So that's Gordon growth. Then you have the multiple approach. The multiple approach. And the multiple approach basically states, I'm going to forecast these cash flows, and in all these cases, these cash flows are 1 year ahead, so the projected cash flows. So you have cash flow, t plus 1, times the multiple. It's going to give you the value of the stock. So if cash flows go up, the values go up. If the multiples go up, the values go up. If the cash flows go down, the values go down. The multiple goes down, the values go down. So the question is, what's the multiple? What drives the multiple? You can calculate the multiple a multitude of ways. First, you can use the price earnings multiple, the PE multiple. For comparable stocks just like yours, for forward-looking projected price earnings multiples, T plus 1. Apply that cash flow to get the value of the security. You could also calculate a multiple using the perpetuity approach. 1 divided by I, it's going to give you a multiple. Multiply the multiple by the cash flow, you're going to get the value. If the interest rates go up, the multiple goes down, the values go down. If interest rates go down, the multiple goes up, and the value goes up. You can also create a multiple using the Gordon growth formula, 1 divided by I minus G. You get a multiple. Well, if interest rates go up, the multiple goes down, and the values go down. If interest rates go down, the multiple goes up, the values go up. If growth rate expectations and cash flows go up, the multiple goes up, and the value goes up. If growth rate expectations and earnings and cash flows go down, the multiple goes down, and the value goes down. That's the multiple approach. And then the last model, and we'll end it there, is the discounted cash flow, DCF. And we'll be doing a lot of DCF in the class. So that's the fourth one. And there's some other ones too, but these are just the main. So this is the what time is it? How much time do I have?
20 minutes.
DCF. This is it. These are important, but this is it. Okay? The most important valuation methodology. Okay? And we'll go over and over and over again. In class, we'll be doing firm valuations, we'll be doing stock valuations, and hopefully you'll walk out of here with a solid foundation to be able to conduct valuations, stocks and firms. You'll be able to do what's called underwriting, because the investment banks underwrite these securities and underwrite these firms using discounted cash flow. It's also called due diligence. And you're also going to be constructing pro forma income statements, which are basically projections of the cash flows using the income statement out over some holding period. And in most cases, most assets, advertising campaigns, marketing campaigns, whatever it is, real estate assets, most holding periods are 3, 5, and 10 years. That's the standard. It's the standard holding period. So if we're going to value, let's say we're valuing a stock or a piece of real estate, a firm, we're going to want to figure out what the present value is of future cash flows. You're going to discount those cash flows back. You guys been practicing your future value factors and present value factors. You are going to project out, let's say over a 3-year holding period, cash flows. And again, you're going to start with some cash flow, t equals 0. You're going to project it out, t plus 1. And that's going to be the first year of your cash flow period and your discount period. And you're going to project out the cash flows, t plus 2, cash flow, t plus 3. And then you're going to discount them back at some expected return or some discount rate or some cost of capital, which will be 1 plus I, the first power, 1 plus I squared, 1 plus I cubed. Then what you're going to do is you're also going to determine some terminal value. Can I sell the stock at the end of the holding period, sell the real estate at the holding period, firm at the end of the holding period, and I'll go through the terminal value calculation. Basically, to arrive at the terminal value, you're going to use either the perpetuity, the Gordon growth, or the multiple model. Okay? Then you discount this all back to the present. You're going to get the present value. You're going to figure out what the cost of the acquisition, the price of the asset is that you're acquiring. You're going to subtract it from the present value to get the net present value, or the NPV. Now, if the NPV, net present value, is positive, you're going to accept the project. net present value is 0, you're gonna accept the project. If the net present value is negative, you are going to reject it. If the net present value is positive, your internal rate of return is greater than your expected return or your discount rate. If your net present value is 0, your internal rate of return is equal to your expected return or your cost of capital. And if the net present value is negative, your internal rate of return is less than your expected return for your cost of capital. I really want the project. I really want the security. I really want the firm. I really want the real estate. What I can do is I can go back and look at the dollar amount of the negative net present value and go see if I can reduce the cost or I can get a price reduction in that amount of the negative net present value, so the amount. And if I can lower the cost of the construction, lower the cost of the acquisition, lower the acquisition price by that amount, the NPV turns to 0, and I accept the project. If I can't get the price reduction and the cost reduction, I gotta go back and re-underwrite and see if I made a mistake on my cash flow projections, if I overestimated the cost of capital, and if I underestimated the terminal value. So I gotta go back and rewrite it, re-underwrite it, figure out if we made any mistakes. If we didn't make any mistakes and we still get a negative net present value, I can do another methodology. I can calculate a real call option. And that's basically the same methodologies that you would use, I think it's chapter 20 or something. You would use what is called a Black-Scholes model. How am I doing on time?
14.
Okay, Black-Scholes binomial tree calculation. Their software deal to do all this stuff. And if I run it through the model, and the value of the real call option is equal to, greater than the negative net present value, my net present value is either positive or 0. And I can accept the project. This is the quantitative model for gut feel. Okay, most venture capitalists, 50% of them, do not use models to make investment decisions. It's been proven, it's in the research. What they do is they sit around and they talk about these companies that they're going to acquire, and they say, this really looks like a good company, it feels really good, I like the founders, the product, looks pretty good, I think we should do the project, with no quantitative analysis done, all based on gut feel. Okay, no quant that's being done. Okay, no unbiased calculations. And the only reason that I can think of that would allow them to get away with that is that if you can pick one Google or Yahoo or Salesforce or startup company, you're gonna make billions of dollars. So it doesn't really matter if you lose hundreds of millions on these other companies, because when you win big. Okay, and it basically masks and covers up all the incompetence and myopic thinking associated with these investment decision makers. Okay. And I'll get into these models, we'll grind through, and you'll see in the following chapters, we'll get into even more pro forma income state forecasting methods. I'll go through the model again. We'll go into more detail. And then what I'll do is I'll take a lot of the stuff that we've already learned and I will integrate it all together into a process. So it basically brings everything together into one sequence of models. Because what happens is in the book and in your program and a lot of the way that people think is it's all basically compartmentalized by chapter or course or program. Nobody integrates it all together. And it took me about 4 years to figure out the model. And I basically set it up in a sequence and basically brought together the whole discipline and then the process and then laid it out so that you can totally understand it in an integrated fashion as opposed to a compartmentalized and specific, problem calculations, because you're just doing the problems, you don't understand how it all relates together. Okay, any questions or anything? Some of this stuff should be review for a lot of you. We've been working through the homeworks and the pre-test papers. Any questions? No? Okay, if you want, I got recorded